See, when we define the word valuation, we are simply, whatever is the mechanism we use, it is the present value of future cash flows. This is what is the definition of valuation, right? So, future cash flows we have already got. We have already found out the future cash flows, at least up to 5 years. From 6th year to infinite years, I'll make some assumption. Well, I'll talk about it. But up to 5 years, we have got the future cash flows. Right? So, this part is done as far as the valuation is concerned. The future cash flows are done. Of course, 6th year to infinite year, I need to have some other mechanism. But otherwise, the future cash flows are done. Now, I need to find their present values. Present value of the future cash flow, which means every year, the future cash flow, I have to discount it by some percentage. Right? So, in other sense, if I am depositing 100 today, the interest rate is 10%. After 1 year, I will get 110. So, the present value of 110 discounted at 10% is nothing but 100 in simpler sense. Right? So, here I need to know at what rate I have to discount it. Then I will get the present value. I need to know at what rate I need to discount it. That rate at which I can discount is what I call as the cost of capital. Right? What is it really costing the company? What is it really costing the company for every rupee of investment that it has got? For every rupee of capital that it has got, what is it really costing the company? So, the way to look at it is weightage of debt, how much of debt capital is there, multiplied by the cost of debt. Cost of debt is interest percentage. Weightage of debt into cost of debt. And of course, this cost of debt is actually is having a tax deductibility. Because in our typical income statement, EBIT minus I, which will be EBT, minus tax, which will be PAT. Now, the tax is applied only on EBT, which means whatever I paid as interest, I am getting a tax saving on that by that extent. If I have paid some interest, I am actually getting some tax saving, because the tax is applicable only on the remaining balance after I pay my interest. If this interest is not there, then my tax is applied on the whole EBIT. So, this tax saving which I have got is actually getting forgone. So, overall cost for me in case of debt is always into 1 minus T, because I save some kind of a tax. So, the real cost for me is only that much extent, because by paying interest, I am saving some part of the tax. So, the cost is not the full cost, but slightly lesser cost, because there is a tax saving that is happening. Then similarly, I will add weightage of equity into cost of equity. This is what is called as cost of capital, or in short we call it as WACC, weighted average cost of capital. Now, this WD comes from the balance sheet. Weightage of debt, how much debt as a part of my total capital. Weightage of equity, how much of equity out of, again from the balance sheet. Cost of debt, income, interest, comes from the P&L statement. Whereas cost of equity or even tax comes from my income statement. But cost of equity does not come from the income statement or from the balance sheet. it has to be estimated. There are multiple ways of estimating that cost of equity, right? There are multiple ways of estimating this cost of equity. Couple of ways. So that is where the slight complex. So we'll do the remaining part, and cost of equity I will come out with the ways of estimating that cost of equity. No, the it is see it is not a mandatory payment. See, if a company does not pay dividend in a particular year, it does not mean that there was no cost to the company. That is just retained back into the business, which means it has to be paid next year. Whereas in case of debt, that is not the case. The interest is fixed. Every year you have to pay it, and you don't pay more or less. Whereas in equity, that's not the case. If more profit comes, you have to pay more. Less profit comes, you have to pay less. Because they are the guys who take the remaining burden, all the equity investors. So the financial statement cannot reflect the cost of equity. It has to come from the market. Weightage of equity. No, that is already okay. Cost of retail. Okay, you are saying apart from cost of debt and cost of equity. No, I mean that is already taken. When I say cost of weightage of equity, I'm including both share capital as well as retained earnings, both of them. You are talking of share capital separately and retained earnings separately. But in general, because see, a company will never go for excess, I mean, raising new funds every year. Mostly it's a cost of a retained earning itself. When I say cost of equity, it's most of it is a retained earning itself. Right? Unless you say that the company goes for a fresh capital this year, then my cost of new equity will be different from cost of retained earnings. Because new equity requires some flotation costs and all that stuff. So that will be slightly more costlier. But otherwise, when we have anyhow made a projection that the share capital is constant for the next 5 years, which means there is no new equity that is getting issued. So whatever is the cost, that's the cost of retained earning itself. Okay, here I'll simply put cost of capital. For that I require weightage of debt, weightage of equity, cost of debt, tax rate, or probably I'll call it as post tax cost of debt, cost of equity, I'll call it as dividend method. I'll use two methods to find out cost of equity. Cost of equity capital asset pricing model method. Similarly, cost of capital using the first method and cost of capital using the second method. So these are the things we'll try to find out for this data. Okay, weightage of debt. Let me just put okay, weightage of debt I get it as the total debt as a proportion of debt and equity. So I can go into the balance sheet. So debt means I'll take both the total non-current liabilities as a proportion of debt plus equity. Equity I include the retained earnings also. So this is 30% was there as a part of the debt, but over a period it has come down. So this is the proportion of debt. Weightage of equity will be 1 minus the weightage of debt. You don't need to calculate it separately. So I'll take 1 minus the weightage of debt. So 69% was equity here, and obviously around 80% was the equity in this year. Cost of debt, interest divided by the total liabilities, which we have already computed. I think as a part of our common size, the finance cost. Interest divided by the total debt. So this was our cost of debt. So 3.95% happened to be the cost of debt, and over the period it has fallen down to 0.12%. So this is what is the cost of debt. This is pre-tax. So I have to find out post-tax. So post-tax is this number into 1 minus t. 1 minus the t we have found out actually the tax percentage we had in that common size. This, there is the total tax by PBT. This is what is the tax rate. 17%. 17% to 22%. So this will become my post-tax cost of debt. Okay, so we have WD, WE, KD into 1 minus T. Now all I require is KE. Now one way to find out KE is the dividend discounting method, which comes out as D1. Okay, whatever is the dividend by the price, market price, dividend by the price, which is actually called as dividend yield. This is the first time we are introducing the market price into the picture, because the cost of equity has to be found from the market itself, right? What it typically is the expectation of the investor. So because they buy in the secondary market, we are more looking at from a market standpoint. So D1 by P naught plus the G. G is the growth rate. The growth rate comes with retained earnings, the retained earning percentage into return on equity. That is what will come out as the growth rate. The retained earning percentage multiplied by the return on equity. Now here I will try to find out the retained earning percentage, right, which will come as 1 minus the dividend payout ratio. Retained earning percentage is 1 minus dividend payout. Dividend payout we have already got. 1 minus in your common size, you have actually found out the dividend payout ratio. So first year there is something negative, but in all the other years, this is what is the dividend payout retained earning. 34% retained, 35% retained, that is your retained earning. Then return on equity comes out as PAT divided by the net worth or total equity capital. Profit after tax divided by the, so because it is return on the equity capital. So return is PAT, equity is the total equity capital, which includes the share capital plus retained earnings. Okay, so PAT comes from the income statement. This is the PAT. Sorry, I'll take it for the first year. This is the PAT divided by the total equity capital, which is this number. So this is what is the return on equity. And slowly we are seeing that's almost 66% is the return on equity currently. Right? Now the multiplication of this two is actually the growth. The retained earning into return on equity. First year it is not making much of a meaning because there is a negative number. Whereas I can look at it from the next years onwards. Let me just compute the percentage to 2 decimals. You see that 27%, 26% is the typical growth. Right? So if I go with this model, D1, the dividend by P naught plus G. This is what is my cost of equity. What is the dividend they are paying? Okay, now, so the dividend we have got here. The dividends they have paid, we have got here in the historical. The number of shares we have got here. So I can find out dividend per share. Dividend per share comes out as dividend divided by number of shares. This is the dividend per share. This is the dividend per share. Now, all I can do is dividend. This is the dividend per share. Now, when I go with, I want the prices also. The market price in each of the years. So, what I'll do is market price also I need for each of these years. This is where I take the stock price data. The stock price data contains the market price. So what I can very well do, this is what is the stock prices. So for 2008, these are the numbers. The stock prices, these are the numbers for each of the years. So now what I will do is, in this or in this, where did I do? Here, the market price, I will simply take the transpose of these 5 numbers. These are the 5 numbers. For each of the years, I have to get the, for each of the 5, I have to get the market price. Now, these are the market prices. Now, based on that, I can find D1 by P naught plus G. So, I will get the cost of equity as per the first method. I will get it as D1 by P naught plus G. G we have just computed it. This is the G. So for the first year, the cost of equity is around this much. Now we are seeing that the cost of equity is around 27% every year as per this. But sometimes if the number ROE and all are very, very high, this number may become more and more aggressive number. Right? Every year the company has to grow at 27%, may or may not be literally feasible also. Right? But that is the kind of potential the company has today. So that's where its stock price will be much, much higher compared to the book value. We'll see that part. So as per this dividend discounting method, the cost of equity is somewhere around that. right? Now, the next thing, so now going with the cost of capital, as per this first method, weightage of debt into post-tax cost of debt, correct? KD into 1 minus T, plus weightage of equity into cost of equity. So this is what is becoming the cost of capital in the first year and probably in the last year. So now at least 22% is the cost of capital as of latest. This is the cost of capital going with this mechanism. Now the other mechanism I can try out is the capital asset pricing model mechanism. But here the way we are defining it is the cost of equity is given by the risk-free rate of return plus some beta times the market return minus the risk-free rate of return. The annual market return minus the annual risk-free rate of return. So risk-free rate of return actually we can get from RBI side, which is nothing but the treasury bills, the typical return that comes on a treasury bill. Beta is the measure of the market risk. Because there is some market risk, higher the risk, higher the return. So depending on how much the beta is, this excess return, which is the market return minus the risk-free rate of return, market always gives, market is like Sensex or Nifty or anything. Sensex gives a higher return than the risk-free rate of return. That excess return is subjected to risk. How much is what is given by the beta factor. Beta is something which we can estimate again through various statistical procedures. But one simpler is, it goes with covariance between the security returns and the market returns divided by the variance of the market returns. So these two can directly be put in the Excel sheet to arrive at that beta. We don't need too much of a process. This is again an outcome of regression itself. But of course, there is a direct formula also available. So security is your HUL prices. Market is Sensex or Nifty. Using this formula, you can arrive at the beta. Put this beta here, you will arrive at the cost of equity. And again, based on that, you can find out the cost of capital. So let's look at that process. So here I require RF, RM, beta. I require these three. Beta I will get as covariance of the security returns and the market returns divided by the variance of the market return. So that's the reason I have collected the stock prices. And probably this beta sheet will contain monthly stock prices right from Jan 2006 till today. Right? So what I'll do is I'll hide all the not required stuff to make the explanation slightly better. I just need these three columns. The closing price of the company, probably this is HUL and Sensex. So I'll call HUL returns and Sensex returns because I need to do the covariance between the returns. So return is coming out as this value minus the previous value divided by the previous value. That is the definition of a return. Final value minus initial value divided by the initial value. Which is, so the return for that month is there was a 24% return in that month. Similarly, I can do for every month. Now the same logic can go for Sensex. the value for this month minus the value of the previous month divided by the value of the previous month. So what it is telling is, you see here, I just put these two in a percentage format. See, in this month, in February 2006, HUL stock price has gone up by 24%, whereas the Sensex has gone only by 4% in that month. The next month, the Sensex has gone by 8%, HUL has gone up by 12%. The next is reverse. Sensex has gone up by 6%, HUL has gone up by 5.75%. Like this is the process. So now, the way I get my beta is nothing but the covariance between HUL returns, comma market returns, Sensex returns, divided by the variance of the market return, which is the Sensex returns. This will tell me that this is the beta. 0.32 is the beta. .33 is the beta. Right, which means for every 1 unit change in the value of the Sensex, HUL is changing by almost 0.33 units. So the HUL is less risky compared to the Sensex. So because it is less risky, the return expectation also should be lesser. So the expected return comes with that formula, RF plus beta times RM minus RF. Now how do I get my RM? The return on the market is nothing but the average return of the Sensex, which I will get this as I will take the average of all these numbers. Average Sensex return. But this is monthly return. Average monthly return. But I want annual return. So I will multiply this by 12. This is the monthly return. So it says monthly return is around 1.04%. But I want annual return. So I multiply this by 12, which says Sensex is giving around 12.52% annual return. This is my RM. Now what I can simply do is, I will come to this sheet. So the beta, see here I will get, if I want the beta of each of the months separately or each of the years separately, I have to do that same exercise, covariance by variance. Here if you want that, a covariance. See, this is 2008, financial year ending 2008. Right? So which means 2007 April to 2008 March. So take the numbers only up to that period. 2007 April to 2008 March. These are the numbers. The security returns, comma, market returns divided by the variance of the market returns. So for each year, you can actually do the beta separate calculation also. Right? For each year, you can take a separate calculation of the beta also. Or for all the years, you can take one single number itself. Now what we have computed as 0.32 is the common across all the periods. Because for some years it may be high, for some years it may be low, because we got 0.32, but in the first year it was only 0.07. So like that, in some years it would be higher, some years it would be lower also. Right? But whatever is the beta, now RF actually comes out from your RBI site. The return on the treasury bills. You go into this market trends. government securities market. The 364-day treasury bill at this moment is 8.0835%. So I will take my RF as 8.0835%. RM we have already got. RM we have got it as 12.52%. And beta we have also got, we'll take the uniform beta overall. This is the beta. Now based on this, I can get my cost of equity, because this is more appropriate model of finding cost of equity than the dividend approach, because this is more driven from the market price and it has been proven as slightly better approach compared to the various other, because it has taken the comparison with respect to Sensex. So there are few other things that are coming in. So that's where this is much better, because it takes into account economy and all that stuff also for the computation of the cost of equity. There is a huge difference. You see here, RF plus beta times RM minus RF. This is only 9.5%. Cost of equity is only 9.5%. You go with 9.53% for discounting all your values when you are doing your valuation process. Right? So this is the uneven cost of capital. Again goes as weightage of the latest. I can take the weightage of debt into post-tax cost of debt plus weightage of equity into cost of equity. So this will come out as the cost of capital. So depending on what needs to be used, in some contexts I have to use cost of equity, in some contexts I have to use cost of capital. We'll discuss about which one has to be used in what context, because the moment we start discussing about the different valuation methods, we'll come to know where which one has to be used. But as an input, the cost of equity and cost of capital are definitely used, because as we defined, valuation is nothing but present value of the future cash flow. The future cash flows we have found out using the projections. Now the present value means at what rate I have to discount the future cash flows. I am doing through this approach. So doing these two things, I can very well arrive at what should be the present value. Now, what are the different mechanisms available to do it are the different valuation methods. So the inputs which are required for doing the valuation, which is the cost of equity and capital as well as your future cash flows, those two are taken care of as a part of the today's this thing. Now I have to understand the different valuation mechanisms. Right? Tomorrow we'll deal with the dividend based discounting model, free cash flow based valuation, relative valuation and a residual valuation. These are four different types of valuations which we have. Using these four different mechanisms, we'll try to see what should be the share price of this. So the valuation output is nothing but what should be the share price of this company using each of these. Sometimes people use a combination of this, but using different valuation approaches, what should be the share price of the company looking at this as the input. Now, so future cash flows we have, future discounting rates we have. Using these, using different methods, we'll try to find out what is the price of each of the shares. That is the process that is left. So we'll try to have the conceptual understanding of that along with putting those things into an Excel sheet. Right?